Why does it sometimes make sense to sell unprofitable products? In this video, you will learn how to use CVP analysis for multiple products and why does it sometimes make sense to sell unprofitable products. In previous videos, I presented CVP analysis, which took into account only one product. However, most companies produce and sell more than one product. CVP analysis can also be used in this case. Let's see how we can adapt the formulas used in a single product setting to the multiple product setting in the example. Imagine a company that produces and sells printers and ink cartridges. In this case, we will have three products: a printer, a black ink cartridge, and a color ink cartridge. The company sells 200 printers, 600 black ink cartridges, and 300 color ink cartridges per month. The situation will be as follows. The unit cost of production of one printer is $18. The company sells it for $20. The unit contribution margin is therefore $2. The unit cost of a single black ink cartridge is $2. The company sells it for $5. Therefore, the unit contribution margin is $3. The unit cost of one color ink cartridge is $6. The company sells it for $8. This time, the contribution margin is also $2. If we add up the number of all products sold, we get the total sales of 1,100 units. At this stage, we can say that the contribution margin is positive in all cases. It has the greatest value in the case of black ink cartridges. The printer and the color ink cartridge have the same contribution margin of $2. As you can see, it is difficult to specify the unit cost, unit prices, and the unit contribution margin for all products together. At this point, things look fine. The company theoretically earns on selling each product. But this is not the end of the calculations. We still have fixed costs. Some of the fixed costs can be attributed to a specific product, for example, related to the production of the printer, others not. For this reason, let's separate the fixed cost that can be assigned to a specific product from the common fixed costs. First, let's deal with those that can be assigned to each product. In the case of our company, it looks like this. The direct fixed expenses are those fixed costs that can be traced to each product and would be avoided if the product did not exist. The total direct fixed cost of all 3 products is $1,000. So let's check what it will look like if we calculate it for all products sold. The projected income statement based on the sales forecast is now presented on the screen.
First, we need to calculate the sales value of each of the 3 products. Then, we calculate their variable expenses. The difference between sales and variable expenses is the contribution margin. Now we can assign direct fixed expenses to each of the products. The last column shows the total value, that is, the total sales value, variable expenses, contribution margin, and direct fixed expenses.
Let's stop at this point for a moment. One possible solution on how to adapt CVP analysis to multiple products is to apply the analysis separately to each product line. It is possible to obtain individual break-even points when income is defined as product margin. Break-even for each product is as follows. Now let's calculate the break-even point for each of the 3 products. As you can see, the company currently sells too few printers. Therefore, it doesn't reach the break-even on this product. Things got interesting. Please note that we obtained a negative product margin on printers. The remaining 2 products have positive product margins. The total margin is also positive. If you analyze only the total margin, you will not know that you have a negative margin on product number 1. Interesting, isn't it? But a break-even product margin covers only direct fixed costs. We'll still have some fixed costs that couldn't be assigned to specific products. The common fixed costs also remain to be covered. Let's assume that they are $900. As you can see, the company as a whole is profitable. The operating income is $900. Somehow, the common fixed costs must be factored into the CVP analysis. Allocating the common fixed costs to each product line before computing a break-even point may resolve this difficulty. The problem with this approach is that allocation of the common fixed costs is arbitrary. It means that the company alone decides how to divide these costs. So, can the costs be split differently? The answer is yes. Fixed costs may be allocated based on the ability of the department, branch, or the ability to bear the cost. For instance, a company may allocate a larger portion of its fixed costs to a highly profitable division while allocating a proportionally smaller portion to a marginally profitable division. This can result in a skewed view of a division or product's true financial productivity. It is the biggest disadvantage of this approach. Unless fixed costs are allocated properly, the resulting information may lead management to make faulty decisions based on erroneous assumptions. In our case, I decided to divide this cost in 3 equal parts. $300 for each product. Our previous formula was slightly modified as the appropriate part of the remaining fixed cost was put into the denominator. Now the break-even point of each product looks like this. Have you noticed it too? Our break-even point has moved to the right, which means we have to sell more units to achieve it. Now let's calculate the operating income on each product. It turns out that the company has an operating income only because it sells black ink cartridges. The CVP analysis should help managers to increase companies' profit. From this perspective, the company should stop selling printers and think how to make color cartridges profitable. The main problem in this situation is that once the company stops offering printers to its customers, they will not need the cartridges for these printers either. For this reason, the company cannot stop producing and selling printers. Some companies deliberately sell one of their products below the break-even point, because this sale allows them to earn money by selling other products. We call these types of products complementary goods. Other examples include Let's go back to the question from the beginning of this video, which was, why does it sometimes make sense to sell unprofitable products? I think you already know the answer. Sometimes, by selling non-profitable products, a company can make money by selling other products. Clever, isn't it?